But tell us a little bit more for our listeners who may not be familiar with real estate crowdfunding. What is that, and why was the Jobs Act so crucial to sort of launching that whole wave?
In reverse order. The Jobs Act, I can't remember the year that it was signed in, but it was...
I think it was 2012.
Yeah, so I was going to say it's about 9 years ago. So
yeah.
It was, Jobs Act stands for Jumpstart Our Business Startups Act. And it came in like a number of waves. So there were, Title 2, 3, 4. So it came in various different stages. But the first stage, which was the most important stage, was changing one of the exemptions that enabled people to publicly advertise real estate investments. Before that change, you weren't allowed to advertise or to publicly solicit. You could only offer these types of private placements, which is effectively what they are, to people that with whom you had a previous relationship. And so really what this did was it allowed you for the first time ever, without having to have a public company, to be able to create a small offering, something that could just be for one property, but you were able to publicly solicit for funds. And there's obviously a few hoops you had to go through, and that public solicitation, you could only accept accredited investors. That's still the case. And you had to make sure that the people that did invest with you really were accredited investors. So previously, you could kind of take them at their word. But this time, if you did want to publicly offer your shares in your private placement, then you had to make absolutely sure that they really were accredited. So there's a bit more compliance involved. But that really gave birth to platforms that were able to post real estate deals that previously would only be available if you knew the right guy at the local country club, or if you knew a guy at a your real estate sort of meeting. So these deals that were previously only available to those with deep pockets suddenly became available, and it gave birth to a number of real estate crowdfunding platforms. And a number of those have been hugely successful and have raised billions and billions of dollars over the last few years, and have really opened up real estate investing for accredited and non-accredited investors, because other parts of the Jobs Act allowed non-accredited investors to invest in these types of structures without having to be public companies. So what it did is, it really opened the market up. And you may have come across other crowdfunding platforms. So it's not just limited to real estate. So you can now go to companies and invest in companies. So you can potentially invest in the next Uber or the next eBay or the next Amazon at a startup level. And that's all been made possible by the Jobs Act.
And what kind of monitoring of the investment, if any, do you do on an ongoing basis, and reporting back to the investors? Do you guys, I don't know, I'm envisioning something like every quarter somebody goes in and kind of tracks the property value or something. I mean, I don't know. What does that look like?
What we do, and again, there's a number of different things. There's the property value, but there's also other things associated with the individual property. So property values, we revalue the properties every month. So what we do is we know how much your home is worth. So when we entered the agreement with you, we knew it was worth $1 million because we had an appraiser. And we then have access to all sorts of automated valuation mechanisms or methodologies that allow us to reliably estimate that homes in your zip code went up by 0.45% last month. So what we'll do is we will adjust the value of your home from $1 million to $1 million,
right.
4,500. So we now say the value of your underlying asset is that, which means that the value of the contract has gone up by that fraction as well. So we revalue, effectively we mark to market all of those investments. Other things that we do, for the individual homes, we'll check regularly to make sure that there aren't any notices of default, or we get notified if there are any notices of default, if there's any problem, if there are any tax liens or any other liens that are put on the property, if we can regularly check to make sure your property is insured and maintains insurance. But a lot of it is down to the homeowner really to maintain the property. And there are a number of clauses within the agreement that say that if you don't maintain the property, if you allow it to go into disrepair, then you're going to end up paying for that out of your share of the equity. So we're going to get a little bit more equity if we have to fix it.